Hey, thank you everybody, and welcome today to our Taxes and Retirement 567. We're excited to have you with us, and like I said, we're glad you're here today. So I want to start today off uh, by having everybody for a moment just think about your retirement. Now, I'm sure everybody is in a different phase or a different place right now when it comes to when you're actually going to retire. Some of you may have been retired for a couple of years. Some may be retiring this year, maybe even in the next couple of months. And then, for others, maybe it's a couple of years away, 2 to 5 years. But wherever you are in this journey of your retirement plan, I want you to think for a moment, what does that look like? When you envision your retirement, look 5 years out, 10 years, even 15 years, what is it that you see? What are some of the things that you want to accomplish? What are some of your goals? More importantly, what are your dreams? A lot of our clients will tell us that they want to travel, they want to spend time with family. Some of the guys say they want to golf, or go fishing. So there's a lot of different things that we hear and we see from our clients that are their goals and dreams. Now, again, hopefully you can kind of envision that for a moment. Now I want to ask another question. What are some of the obstacles that stand in your way? What are some of the things that might impede those dreams to come to fruition? And think about that for a moment. We've got these great desires and goals, but once we get to retirement, how likely is it going to be that we can achieve those goals? Now, some of the things that might stand in your way, and we hear this as often as well, but might be the market, right? We retire, we have our investments, the market may go up, may go down, but that's something that could kind of stand in our way if we have a bad market cycle. Another obstacle might be, what if one spouse predeceases another much earlier than anticipated, and we take a hit in income? So what's that economic impact of losing a spouse? Something else that we hear is longevity risk. What if I live, instead of 15 years, what if I live 20 to 30, right? So there's a lot of things that could stand in your way when thinking about your dreams and goals in retirement. But how many times have we thought about taxes? How many times have we thought, if taxes change, that might change the landscape of my retirement? That's something that we want to address today. We want to make sure that if you're 5, 10, 15, 20 years into retirement, when those days come, how likely are you going to be able to achieve your dreams? So the one mistake that we see time and time again when people come to visit us, they may have a great retirement plan and they may have a solid investment portfolio, but they haven't taken taxes into consideration. And there are so many things that are always ever changing with taxes. But we do want to address what are some areas that we can address, look at, and help to really remove some of those obstacles. So that's exactly what we're going to do today here in Taxes and Retirement. I'm Colin Redinger. I'm one of your presenters today. And Josh Blaker, my business partner, he'll be another presenter. So we'll both take turns going through some different parts of taxes and retirement. So just to give you a quick background, this is my wonderful family. I've got my wife, Heather. We've been married 14 years. So I'm sure a lot of you on the call today have been married much longer than 14 years, but we've got 14 years now under our belt. And Heather says that 2 of those were great. We've got 4 beautiful kids. So our oldest, Cohen, he's 12 years old, and he's kind of taken after his old man that he loves to golf. We've got Noah, that's standing up there in the black shirt, and he's our basketball player. He loves sports. He loves stats. Grayson is 9, and he's just super active, gets involved with everybody, kind of brings everybody together. And then, of course, we have our daughter last, and we kept trying until we got a girl. So my daughter, Liv, she is 6 years old. And then Josh has been married now 16 years. He's got his wonderful wife, Marcy, and their two boys, Caden and Chance. Caden's the oldest. He likes to skateboard. And then Chance is actually an incredible soccer player. So he's in a lot of club soccer leagues and does really well. So that's a little bit about us. Josh and I have been together now for about 5 years working together, and we've been in the industry about 20 years. So we're real happy to be here with you today. One thing that we feel is very important, and you may ask, why are we teaching these type of classes? Why are we taking the time to educate clients on taxes, right? Well, it's this one word right here, fiduciary. As fiduciaries, we have a moral, legal, and ethical obligation to put the needs of our clients first. And so we're always looking at different ways to educate and different ways to help improve the retirement path that our clients are on. Now, I want to change gears just for a moment and ask you guys a question, a very easy, simple question, but I also want you to type in the answer if you can, because I really want to make sure that the question and answer tab works. That way throughout the event here today, if you do have questions, we can see those and take those as they come, or oftentimes get to them at the end. But what color is a stop sign? Right now, that's a very simple, very easy question. Again, if you click on the Q&A, you'll be able to type in your answer there. So I'll wait here just a second. And we've got some responses here. Of course, everybody's correct with red and white. So let's double check that. And that's true. Stop signs are red and white. Very good. What color is a yield sign? So again, just type in there under the Q&A tab. Let us know what your answer there. And I'm starting to see them come in, and I'm getting a lot of yellow and black. So would you agree? Would you say that, yes, a yield sign is yellow and black? The reality is yield signs are now red and white, right? It's always a little funny to think about, our mindset. We're still stuck in that old way of thinking of yellow and black. And of course, they were yellow and black at one point in time. And there are still yellow and black ones today. Not every one has been ripped out of the ground and replaced with a new, fresh red and white yield sign. But they have actually stopped producing the yellow and black yield sign back in the late 70s. So it's a little funny there to think about that. Even though that's been a change that was made 40 plus years ago, we still associate yield signs with the color yellow and black. Now, what does that have to do with what we'll talk about today? Very simple. The old myths and misconceptions, the old world, can cause harm to us in the new world. A lot of times we're stuck in that old way of thinking, whether it be with investments, whether it be with how we take income in retirement. The way we were taught and trained can be much different today than it was 5, 10, 15 years ago. So again, we're thankful that you're here today. That shows that you continually want to educate yourself and find new ways to be strategic and help yourself out in retirement. Today, what we are going to talk about, here's our agenda. There's going to be a few different topics, but I'd say the main topics that we'll focus on are historical and potential future tax rates. So where have taxes been and where might they go in the future? What are the tax buckets? There's 4 tax buckets that we want to focus on. Also, Roth conversions. How does that impact or play a role in your retirement plan? And then tax strategies. So those are the 4 areas that we're going to hit on today. Now, in this webinar that you're on, there's no way we can cover everything and all things taxes and retirement, but we do want to focus on a few, and then always give you an opportunity down the road to come in and see us and continue to find out what makes sense for you. So here you're going to see a link pop up several times throughout the event. Typically after we go through a topic, you'll be given the option to click on a link. And if you want further information regarding that topic, please just find our calendar here, and you can schedule a 20-minute, a minimum 20-minute session. That can be a 30 to an hour, but whatever is convenient for you, and you can see our calendar and make sure that that works with us as well. So, today we'll have those opportunities to schedule a visit. So getting right into it here with the historicals, this is about a 100-year history of the tax rates. So if you look, back in 1917 all the way through really 2020, what have those tax rates looked like? We see as high as right there in the early years in the 80s, the 80% tax bracket. It dropped all the way to about 25%. We see it as high as 94% during World War II. And right now, when you look through the grand scheme of things, right, in the 100-year average, we're actually at a pretty low point in time with regards to tax rates. So if we look at this and we think, what's the future hold? What are things going to look like for the next 5, 10, 20 years? That's right where you're at today. You're near retirement, and now we need to understand, do you think taxes are going to go up? Are they going to go down or stay the same during your retirement? And that's the question. And nobody has a crystal ball, but there are a lot of indicators helping us to make solid, educated-based decisions that there's a good chance, yes, taxes could go up in the future. The most common filing statuses out there are single and married filing jointly. So I'm going to focus just briefly here on those two tax brackets. So again, if we're looking at a single individual and we're looking at the marginal tax brackets, the lowest is 10% and the highest is 37%. Okay, and we can fall anywhere between 10 and 37%. As we're making more and earning more, then we can jump from one bracket to another, and we can go from 10 to 12, from 12 to 22%, and so on. But again, 37% is the highest. If we look at a married couple filing jointly, the brackets are the same, but the dollar amounts that separates one bracket from another change. So we see now we can make up to $19,750 and still maintain that 10% bracket. Whereas before, if we were a single filer, that'd be $9,000 right around there, where we'd be in that 10% threshold. Okay. So again, understanding the marginal tax brackets is very important, and we'll talk a little bit more about that, but let me give you an example. We've got several people on our webinar today, and for some of you, this will be a quick history lesson. For others, this may be new information, but one thing that we want to make sure everybody understands is when we're talking about marginal tax rates, not every dollar is taxed the same, right? It's not retroactive. So let's say I'm an income earner, I'm working, I'm married, filing jointly, and I have $120,000 of earned income for the year. Well, the first $19,750 is taxed at 10%. So you see there, 10%, that's $1,975 that's going to be, showing up on the tax return. The next $19,000 to $80,000 is taxed at 12%. And from $80,000 to $120,000, because that's all I earned, right? $120,000 is taxed at 22%. So if you add up all my taxes for the year, right? And then we say, what's that percentage? Well, that percentage is going to be about 9.96%. So, our marginal tax rate is much different than, the overall, what we've gotten into from one tax bracket to another. Now, another interesting thing that we want to show you that's very important is right now we're in what's called the Trump tax code, or Trump tax cuts, also known as. So back in 2017, President Trump passed, some new legislation and some new laws that lowered taxes. Now, those are set to expire in the year 2025, at the very end of 2025. Now, unless it's passed and changed prior to that, which is very possible, otherwise it will expire by the end of 2025. But what does that mean for you and I? Well, we can see that right now, taxes are on sale. Taxes are at a discount. So again, look at 2017 compared to a year later at 2018. We can see that the 28% bracket on the 2017 chart there, if we made, anywhere from 153 to 233,000, we were going to be in a 28% tax bracket. So let's say we wanted to remove some money from our IRA or remove some money from our 401k and convert that into a Roth, which Josh will talk about a little bit later. If we wanted to do that and we were in that 28% bracket, we're going to have to pay quite a bit in taxes. But now looking at the new changes, we can make up to $315,000 and be in a 24% bracket. So now we can earn more and we can convert more and pay less in taxes, right? That's a big deal. So we'll talk more about that as it goes on. Here's a very, very, in my opinion, one of the most important slides of the webinar today. So if you're at home, if you've got a paper and pencil or a pen and paper there, you might actually want to write this down, but there's also going to be a handout that we'll have made available to you here in a moment. So, but let me explain what the tax planning or the 4 buckets are. So there are 4 buckets when it comes to taxes, and how our investments are treated and how our investments will be taxed, right? Now, think for a moment of your portfolio. Think of the different investments you have. Most people want to be diversified. We don't get many people coming into our office with $1 million and it's all tied up in one individual stock, right? We got $1 million in Amazon, or we have one stock of Apple for $1 million, and that's all we have. We don't see that very often because we want to have a higher level of diversification. We want to use equities, we want to use bonds, we want to use fixed income, domestic, foreign equities. There's a wide range of tools. There's a wide range of investments out there. And if we have all those working together, we can achieve a higher level of diversification, which in reality is important to lower our risk, but still achieve our goals of a return. There really should be no difference when it comes to diversification among tax qualifications. So when we're looking at our investments, do we have our entire investment portfolio made up of IRAs? Do we have our entire investment portfolio made up of after-tax dollars? What does that look like? So when you come to see us, we are going to draw out and map out for you your investments and how they're going to be treated as taxes are concerned. So bucket number 1, the taxable bucket, there's a lot that can happen in the taxable bucket. Think of after-tax monies. So you worked, maybe you contributed to a 401k. At the end of the year, who knows, maybe you had 20,000, 30, 50,000 sitting in your checking or savings, and you decided, I want to take some of that and I want to invest it. But I've already met my limits for the year with regards to my 401k contributions. So I'm going to open up a brokerage account. I'm going to open up a Fidelity, a Schwab, an Edward Jones account, and I'm going to fund it with this after-tax money, right? Well, how is that going to be taxed as you're growing and you're earning interest? So this taxable bucket is really the most confusing and has lots and lots of different ways that it can be treated. So for example, let's say you have a $100,000 CD at the bank. Now this CD was purchased with after-tax dollars. And maybe you bought a 5-year CD, and maybe you're getting 2% interest, which is $2,000 a year, and you're not even going to touch it until it matures, which is, again, 5 years from now. Well, if that's the case, and you're earning 2% of interest every year, and you're not touching it, are you still going to get a 1099 each year for the interest, for the gain? And the answer is yes. So whether you spend it or not, whether you cash it out or not, if that's held at a bank with a CD, you're going to generate a 1099 every year for the interest. Well, what if that same $100,000 was used to purchase some stocks? Maybe you bought, 10 different stocks for $10,000 each. And same thing, you're not going to touch it for 5 years. Well, are you going to get taxed as the appreciation of that stock goes up? The answer is no, right? Now, you are going to generate some taxes when you sell a stock, but that's the difference. In that taxable bucket, there's different investments that we can find. There's different investment vehicles, and each one is taxed differently, right? Well, what if we sell that stock in 6 months? What if we had some really good results, some really good appreciation, and it grew by 50%? And now our $100,000 has grown to $150,000, but we think, hey, that's too good to be true. Those stocks might actually go down eventually, but let's cash out now. Well, if that's the case, we're going to generate, some taxes there. Now, it's either going to be short-term or long-term capital gains when it comes to investments. Unfortunately, because we sold these 6 months, that's going to generate a short-term capital gain. Short-term capital gains are treated just like ordinary income. So it's going to revert back to that target that we talked about. It might bump you from the 24% bracket to the 28% bracket. So we got to be careful there. Well, what if we held that investment for 366 days? Well, now it's going to be a long-term capital gain. Long-term capital gain tax rates are than our marginal tax rates every time. Those are either zero tax rates there. So we want to make sure that, if we're selling a stock or selling an equity, if we have the opportunity, let's wait until it's been a year. Again, in that taxable bucket, that's where you really want to come in and see a professional and have them look at the different tools that you have, the different investments that you have, and is there a way to lower your overall tax burden, right? There's ways and strategies we have, what's called tax loss harvesting. If we do want to sell some stocks or some mutual funds, but we want to avoid paying those taxes, but we've had some great appreciation, there are different ways to offset that. But again, that taxable bucket, we had a client came to us about 2 years ago, and I still remember this appointment because it was one of my favorite ones I ever had. Client came in with a letter that he printed from his email. He came in with it from his CPA, and his CPA said, you need to meet with a financial planner, and you need to find a way to lower your taxes because you've got all this money in the taxable bucket, right, in the after-tax buckets there. And based on your returns and based on all these positives, you're paying way too much in taxes. So he came to us with a problem saying, is there a way to fix this? And there was. And we showed him how to get from the taxable bucket to the tax deferred bucket. And now he's been able to defer those taxes for a couple of years. So bucket number 2 is our tax deferred bucket. Now, what would you find in a tax deferred bucket? What would you find there? That's very simple, right? It could be an IRA. It could be a 401k. It could be a 457 plan or a 403b. But it's going to be one of these types of plans that's funded with pre-tax dollars. So here, the IRS has allowed us to fund with pre-tax monies. Typically, we'll get a tax deduction, right? Now, there are contribution limits on how much we can put in, and there are different rules in the tax deferred bucket. But the great thing there is that we don't have to pay taxes until we take a withdrawal. So we can defer those for a while. Now, again, there are other rules. We can't pull money out of that bucket unless we're over the age of 59 and a half. Now, there are certain exceptions, and we can walk you through that on an appointment, but typically, rule of thumb is you cannot touch it prior to the age of 59 and a half. If you do, the IRS will penalize you 10%. Another rule inside that bucket is you have to take money out at the age of 72. And if you don't, the IRS will impose another penalty. This penalty is a bit higher. It's 50%. 50%. So there's a lot of positive in the tax deferred bucket, but there are a lot of rules that we need to follow to make sure it works in your favor. The third bucket there is our tax-free bucket. This is where, we can find Roth accounts. Municipal bonds are also tax-free. However, on municipal bonds, they're only tax-free on the interest at the federal level. It can be at the state level based on where the bond was purchased and where your resident address is. However, the appreciation of that bond is going to be taxed. So if we cash out that bond in 5 years and we earn some growth on it, that part is taxed. But the interest year in and year out on the federal level is going to be tax-free. Roth IRA, Roth 401k, tax-free. Life insurance is tax-free. And there's different ways to fund life insurance contracts to use it for tax-free income. But those are some investments that we could find in our tax-free bucket. The last one is the income and estate tax-free. This is a whole nother ball game. This is, there's something called estate tax. So if you pass away and your heirs receive the estate, and as a single, if you have over 11,500,000, or as a couple 23 million, then there's additional taxes that the estate would have to pay. So there's different strategies that one would use to avoid some of those estate taxes. But the first three is where we're going to focus today. And again, some clients come to us and everything is in the tax deferred bucket. Everything's in bucket number 2, or everything's in bucket 2 and 1, but they have 0 in bucket 3. Remember, we want to be diversified within our assets. We also want to be diversified within our tax buckets. Once we get to 72 and we're pulling out required minimum distributions, what's that tax impact? Do we want to take out more than we need but have to pay more in taxes? No. Or what if we need a distribution one year because, maybe we want to buy a new car, or we want to help our children out with something, some first-time home purchase, right? Whatever the case may be, if you want to go to your assets and take out a lump sum, but the only bucket you have is bucket number 2, well, there's a concern there. Okay, so let's talk about how we can move from bucket 1 to 2 to 3. Now, again, the tax bucket strategy, we believe, is very important. We believe that if you have a retirement plan, blueprint, a roadmap to retirement, that, you ought to understand how these tax buckets work. So this is something that we want to give everybody that's on the webinar today, whether you book an appointment or not. What you can do is you can go to the handouts tab up there in the upper right. If you click on that, you'll see this handout, and there's 2 options. One looks like an eye, like an eyeball. The other looks like a downward arrow. One is a preview button. The other, which is the arrow pointing down, is where you can download this. So please, everybody, take the time, download this brochure, the tax strategies for retirement. Buckets create tax choices. So again, that's something that we want to give to you today, but take the time to look at that. Now, if any of these areas that we've discussed so far, maybe you've got some brokerage accounts that you are seeing a lot of a lot of the interest or a lot of the growth show up on the tax return every year, and you want to figure out a way to reduce that, please click on the Calendly link and choose a time that you could meet with us and book that appointment. Again, very simple. You'll click on the link. It'll take you to our calendar, and it's very easy. All right, now I'm going to bring Josh up here and let him go through some different concepts with you as well.
All right. Well, I think what Colin was talking about with those tax buckets, that white paper, that handout is going to be very beneficial to you. So please download that, and that's going to really bring everything full circle, and you'll get a lot more out of this course today. Now, I'm from a place back in Illinois called Champaign-Urbana. And back in Champaign, I had an opportunity to go to my great mommy, it's my great grandma's 100th birthday. So she looks pretty good for 100 years old, right? Well, she passed away at 101. And, the number one fear of retirees above even death is outliving your money. So I like to use Great Mommy as an example that with the proper planning, we want to make sure no matter how long you live, even if it's 101 like Great Mommy, that you're going to be successful, that you're not going to run out of income. And if taxes go up, and the amount of income that you have that you still need to sustain your lifestyle isn't going to be affected. So again, I like to use Great Mommy as that example of one of the risks in retirement is longevity risk. Now, we know when you have an IRA or retirement monies, there's what's called required minimum distributions. And Colin touched on this a bit, where if you don't take that distribution, it is a 50% penalty, which we don't want anyone to ever have to pay. But the year you turn 72 is when you have to start taking out required minimum distributions. Now imagine this. Imagine you're in the position where you've got all the income that you need and you haven't had to take any withdrawals out of your IRA accounts. But all of a sudden you turn 72 and you have to take a distribution, not because you need it, because you have to. Now you're in a higher tax bracket. And in the future, we do anticipate tax rates probably going to be at a higher level than they are today. So taking a required distribution can have a domino effect on some of your benefits in the future. So each year that required minimum distribution increases. So like my great mommy at 101, her required distribution was over 16%. So it starts off close to 4%. Each year it increases. So we want to make sure we look at your current situation about incorporating those required distributions. How is that going to affect your tax bracket and your future income plan? Now, as we take distributions, let's say required distributions or withdrawals that you need for living expenses, the sequence of returns can have a huge impact. So here's an example of two brothers. Each have $500,000 in their IRA, and both are going to pull out $30,000 a year for income. The difference is Steve retires in 1990 and Bill retires in the year 2000. So let's see what the difference is. Now, Steve, again, retiring in 1990, taking out $30,000 a year withdrawals, starting with a balance of $500,000, he ended up with a balance of $1,234,328. So he actually took his income and his account grew. That's the sequence of returns. Now, Bill, his brother, retired in the year 2000, same $500,000 IRA, same withdrawals of $30,000, but because of the sequence of returns, he ended up with $156,000. That's a huge difference, and that's just on sequence of returns. Now, if we add in the tax impact of taxes increasing and the amount of income you need to live the lifestyle you need, taxes can compound the downside effect of the sequence of returns. So we want to make sure that no matter what sequence of returns you have, that in retirement, you're focusing on the things in life that bring your heart happiness and joy, not the worry of, are taxes going to go up? Is my income going to run out? And we have the technology and the ability now to do what's called a stress test. So we can look at saying if the S&P 500 is a risk number of a 75 and you want to be a risk number of a 36, what does that look like? If the S&P were to lose 30 to 40%, what do you expect to lose? And we can do a stress test to make sure that your heart matches the risk number that you want it to be. How are you invested on paper versus how are you invested with your heart and where you want to be? And we can make sure you're on track to confirm that you're on the right track. So another action step here is to click on this Calendly link and we can schedule a time to visit. And I know Colin talked about this being a two-part course. The first part is in a group setting like this webinar. And the second part is where we are available to speak with you one-on-one and answer more specific questions for you and even get you this analysis. Now, when we talk about traditional IRA versus a Roth IRA, there's some dramatic differences that can really add up to be a benefit. So again, back in Illinois where I'm from, there's a lot of farmers. So imagine a farmer has his bushel of seeds and he has the opportunity to pay tax on those seeds now. So he pays taxes, he plants the seeds, he has this huge harvest, it's all tax-free. Versus the idea where he has his seeds, he defers the tax like in a traditional IRA. The taxes are deferred, he plants them, the huge harvest now is all taxable, and tax rates have the ability to go up to a higher rate. So think of a Roth IRA as paying tax on the seeds now and having a huge harvest of tax-free money later. So some differences between a Roth IRA and a traditional IRA. Roth IRA are post-tax contributions. They grow tax-free. Distributions are tax-free. There is that 10% penalty on if you take it under the age of 59 and a half, but there's no required minimum distribution. That's huge. You only take it if you want to, and if you do take it, it's tax-free. The downside is if you make too much money, you can't contribute to a Roth IRA, but you can do a conversion. So a traditional IRA is pre-tax contributions, earnings grow tax deferred, distributions are taxed as ordinary income. So whatever tax rates are going to be in the future, that's the unknown, that's the risk that we take with that. There are required minimum distributions. So again, starting at age 72, we're going to have required minimum distributions that we have to take, but there's no earnings limit. So you can make as much as you want to and still contribute to a traditional IRA. And for our high earners out there, the strategy is you can contribute to your IRA, and then the next year you can do a conversion to a Roth IRA. And that's one of the strategies we can talk about. But with Roth IRA, there's two 5-year rules. So rule number 1 applies to contributions. If you're contributing to a Roth IRA, there is a 5-year clock before those benefits in that Roth IRA are truly Roth benefits. So there's one 5-year clock. A lot of times when we're helping people do Roth conversions, we strategically do that over a few years to maintain the tax bracket that they want to be in. So if we've got 3 different years we did a conversion, each 3 years has its own clock that is a 5-year starting point. So we need to keep track of that as well. Now, think about when we're doing a Roth conversion. Let's say back in February last year, you had $100,000 and you wanted to convert $100,000 traditional IRA to a Roth IRA. And that would be 24% taxes at about $24,000. And let's say the market had a bit of a correction. So that spring got compounded a bit. So now your $100,000 is worth $70,000. Now that $70,000 should go back up with the market, but if we wanted to convert that, now we're paying tax 24% on $70,000 is only $16,800. So we're able to take advantage of the volatility of the market, make that work for you instead of against you, pay less tax, and now when the market recovers, that's all tax-free. So there are ways to strategically get money from that tax deferred bucket to the tax-free and take advantage of the market volatility at the same time. So again, that's when it comes back to those tax planning buckets. Taxable, tax deferred, tax-free. What are some strategies to get us from tax deferred to tax-free? And that's when we start building an income plan. We don't take all the money out of just one bucket. We have strategies to systematically take withdrawals from each of those buckets to get you the most amount of income paying the least amount in taxes. And that's where we can show you an example of a fully written defined income plan that is tax efficient as well. Now, here's an example of a conversion. Let's say we have a 65-year-old in a 25% tax bracket with an IRA of $500,000. So the purpose of this example is we're going to assume the IRA grows at a 4% interest rate. And we also assume that the account holder lives to age 90, and you're going to reinvest the required minimum distributions into a taxable account earning 3%. Okay? So let's say we keep the tax deferred account, we keep the IRA the way it is, and we start taking out our required minimum distributions, and the total required minimum distributions taken was $164,337. Taxes paid on the reinvested required minimum distributions. So now that's money sitting in a 3% bank account, but you got to pay tax every year now on that interest rate. So that's $67,388 of taxes paid. And then the beneficiaries on the remaining balance of the IRA paid $106,665. So if we add all that up, that's about $338,000 of taxes paid on a $500,000 IRA. Or we do a Roth conversion of that $500,000, and there's lots of different ways to do that, but taxes paid approximately $125,000. So either way, the total taxes paid with that Roth conversion is far less than staying with that IRA 100%. And this is one of the areas we can show you is if you did a Roth conversion, how would that benefit you and your family and pay less in taxes? So when we talk about provisional income, what is the provisional income? It's the income that the IRS tracks to see if your Social Security will be taxable. And this is a big issue because most people are taking Social Security income. And there's limitations as far as tax brackets if you're married or filing single. But let's take a look at what counts. So all earned income counts as provisional income. Distributions from your IRAs, pension income, rental income, required minimum distribution income, interest from muni bonds. So muni bonds are tax-free, but the interest from muni bonds, the IRS calculates for taxable income. And then 1/2 of your Social Security. So if we take a look at an example, let's say we've got gross income of $32,184, and then we've got our Social Security income of $40,596. So if we look at the next line, we add together the gross income and then 1/2 of the Social Security income. So that's $52,482. Now, 0%, if you're married filing jointly, up to $32,000 is taxed at 0%. 32,000 to 44,000, that's 50% is seen as taxable. And then anything over $44,001 is up to 85% is seen as taxable. So in this case, taxable Social Security was $13,210. With our type of planning, we want to look at what is your current taxation and how can we get you more income and pay less in taxes. Now, 75 to 85% of the time, women outlive men. And what we look at is having a financial plan, a written plan as a couple, and if one of you become a widow. So let's look at the joint. We have married filing jointly. We have a couple that their IRAs are pulling out $30,000 a year of income. And then the husband is getting $20,000 a year of Social Security, and the wife was getting $10,000 a year of Social Security. So together that's $30,000. So their total income was $60,000 a year. So with standard deductions and personal exemptions, their taxable income was $9,850. So tax due $985. That's married filing jointly. Now, we had a couple come into our office and we're talking about what's called the economic impact of losing a spouse. We're talking about the situation of what if her husband passed away? And she got a smile on her face. I said, wait a minute, why are you smiling about that? She said, well, I'm going to get a raise with Social Security, won't I? Because if one spouse survives the other, you lose the smaller Social Security and you keep the larger one. So she was getting $10,000 a year. He was getting $20,000 a year from Social Security. So if her husband passed away, she's going to get $20,000. I said, wait a minute, let's do the math. As a couple, you're getting $30,000 of Social Security. If your husband passes away, you're losing yours, which is 10. So you've lost 10,000 and you're keeping 20. She said, oh, I get it. But she still had a smile on her face, talking about her husband passing away, but that's a whole different story we won't get into here. So let's say she still had a need of $60,000 a year of income. So now she has to make up the difference out of her IRA, which is taxable. So now she's pulling out $40,000 a year of taxable income out of the IRA, $20,000 from Social Security. So that's the same $60,000 a year of income, but now she's filing single instead of joint. So now that same $60,000 a year of income, taxable income is seen as $44,250, which means she's paying out $5,594 in taxes for the same amount of income when she was married, and she was paying about $985. That's a huge difference. Now, had we done some Roth conversions, whether it's married, filing jointly, or single, you can see this third column that there's not too big of a difference there. Tax-free income today, tax-free income in the future is going to put you in a more efficient position regardless. So again, if you click on this Calendly link, this will give us a chance to take the information we talked about in a group setting today and be able to answer specific questions for you one-on-one. We can do it over a phone call. You can come into the office, but we want to make sure that you get the right information so that you can make intelligent, logical decisions. And that's what we're here for. Now, another concept we want to talk about is the marginal tax rates. How much of your last dollar do you actually pay to Uncle Sam? So when we do a tax map, and this is another report that we can run for you, this is what a normal tax bracket should look like for married filing jointly. You know, the more money you make, the higher that tax bracket you bump up into. And with married or long-term capital gains, we've either at 0, 15, or 20. But let's look at a situation. John and Jane, married filing jointly, age 65 or older, $60,000 of combined Social Security income, $15,000 of net long-term capital gains, and then $45,000 of required minimum distributions. We ran their tax map, and there was a situation that came up. And this is what it's not supposed to look like. But you see where it says 49.95%? What caused that bump? Well, let's look at what they did. So they wanted to give their grandson an additional $1,000 to go traveling. Now, today with COVID and things like that, we aren't able to travel as much, but they wanted to pull out an extra $1,000. That would have been $120 of taxes estimated. Well, what actually happened was that $1,000 additional withdrawal out of the IRA at a 12% bracket was $120. But that caused $850 to be seen as taxable for Social Security, $102. And then that caused $1,850 of capital gains to be taxable at a 15% bracket. That's $277.50. So you add those together, that's $499.50. That's about a 50% tax rate by taking an extra $1,000 withdrawal. We want to make sure that if you are going to take a withdrawal, we look at the tax impact overall to make sure you don't pay unnecessary taxes on money that you need. So there's a lot of tools for tax control. And that's where when we visit with somebody, we look at building a properly diversified income plan, a diversified income plan, using tax diversification, the different tax buckets, and pulling out withdrawals the proper way. Properly blend withdrawals from different accounts. So again, as a holistic advisor, as a fiduciary who has a moral, legal, ethical obligation to do what's in your best interest, when we do complete planning, the tax plan is one of the 5 key areas that we look at. We look at building a fully written defined income plan. We look at investments and the amount of risk and volatility. We look at the healthcare plan with Medicare planning and long-term care. And we finish it with legacy and estate planning, making sure that we morally, legally, and ethically avoid probate and leave less to the IRS and more to your family. But having a written, complete plan is going to give you the confidence that you've addressed those issues. So as we finish our webinar today, what are your economic impact of losing a spouse? What would happen to your financial situation if the stock market dropped 40%? If you died this year, how would your family's lifestyle change after paying a big chunk to the IRS? And what changes have you made to your current plan to take advantage of some of these tax laws to work for you instead of against you? So it's real simple. On our first visit, what's going to happen is we're going to have a simple discussion to find out in your heart, what are some of the priorities? What are your goals, needs, and resources? And what you'll learn is some of these high-level topics we talked about today, how do they actually apply to your unique situation? How long will it take? Well, initially, the first phone call can take even just 20 minutes. We can decide if there is a reason to continue our discussion and potentially even have a face-to-face visit. And you're going to feel very confident when it's over, that not only did you take the time today to listen to this webinar and educate yourself, but you took the position to actually make a difference and do something about it. And again, as a fiduciary, we're not here to sell you something, but we are here to find out how can we assist you and prove to you that you're on the right track and give you the confidence to sleep well at night. And really, there's three possibilities. When we have that visit, we can decide we want to work together and we begin to discuss specific ideas and strategies. Or we decide we like each other, but the timing isn't right. So we make a time to follow up in the future. Or we decide we don't like each other and you leave screaming and calling each other names, but that has never happened. So again, this class was designed on purpose to be two parts. The first part as a webinar in a group setting. The second part where we can take that time to have a discussion with you and answer some questions more specifically and get you those white papers, get you those reports on your tax planning and get you the reports on the amount of risk you're taking and help you make logical decisions that will be in your best interest. So we're going to go ahead and leave this slide open for you to click on that link, on that Calendly link, and figure out what is the best time and day for us to have that phone call visit, and then it can also lead to a in-person visit if you'd like. So as we have that Calendly link open there for you, we're going to open up to any questions that anyone may have in the audience. And one I see right here is there a cost to have a phone call with you? And the answer is no. You know, teaming up with Taxes 567, part of our services is to teach this course and then be a resource for questions and some of the analysis and feedback that we give you. So the first and second visit, there is no cost to that. Another question is, where is your office at? So our office is located right off of Southern and Alma School Road, right across the street from what used to be Fiesta Mall, and we're in that used to be the Bank of America building. So we're on the 11th floor there. And it's a real easy place to find, and we'd love for you to come see our office and meet our team. Let's see here. Another question is, how did you get started in the business? Well, both Colin and myself are second-generation financial advisors. So we've been in the industry about 20 years, and we used to work with our fathers, and then we teamed up about 5 years ago, and we started our own firm as a fiduciary firm called Accrue Wealth Designs. And, you know, we absolutely love what we do. You know, Colin showed you the pictures of our family in the beginning, and we love to treat our clients like family as well. So we are here for the long haul and to build relationships, not just treat people like a client. So any other questions that come through, we'll be able to email you and reach out to you. But we, again, from Colin and I and Accrue Wealth Designs, we wanted to thank you for taking the time to watch our webinar, and we look forward to speaking with you guys soon. Have a great rest of your day. Bye-bye.